if you don't at this time, there will be another question period at the end of the day. And I should say that Milton Zwicker has very kindly agreed to stay on after the program. A group of you are up here looking at his materials, and he will be available again at the end of the session. If there are no questions, we'll move on to the next topic. Oh, I'm sorry. Yes, sir. Well, well, I'm not really sure how you can. I mean, the reason we practice in partnerships is to have unlimited liability. I understand that BC is not only allowed incorporation, but according to, I think it's Lawyers Weekly, the incorporated BC lawyer has limited liability. I just don't understand that or can see it. I can't see the BC Law Society permitting it. So if you're talking in terms of judgment proofing the practice, I don't think you can do it. Does anyone on the panel have any? Lots of insurance. In a way, just one comment on that. If you're going into partnership for the first time, that's presumably one thing that you should examine in respect to your new partners, whether or not, in your view, they're competent, careful practitioners, because you're buying their liabilities too by becoming their partners. Yes. That's a comment. I'm sorry, I'm going to repeat the comments and questions for the benefit of the tape. One gentleman has suggested that anyone joining a partnership or going into partnership with other lawyers should do an errors and omissions search with, in respect to that firm or lawyers. And that's an interesting comment. I'm not sure whether or not the Law Society or the Law Society's insurers would reveal that information. Does anyone in the audience know? I will try and get you an answer before we finish from Joel Kohm. But I suspect there are confidentiality rules, and if I wrote in and asked about a particular firm or lawyer, I would not get an answer. Yes, sir. If I can try and summarize your question. The question is whether or not on the merger of two law partnerships you should do a complete conflict search, and in particularly in real estate. Well, I'll try and answer that simply, and maybe people in the audience will have a better answer for you. If the result of the merger, new partner A is acting for a vendor and new partner B is acting for a purchaser on a transaction that hasn't yet closed and will close after the partnership is formed, I would say yes, there is an inherent conflict, and I would not want to proceed at least without the written confirmation of the clients, and even then I would be uneasy. I would think the two partners would have to agree to transfer one of the clients out. You mean past real estate? I wouldn't consider that a conflict. In smaller communities, lawyers often act for the same parties or different parties at varying times. And I don't think it's a conflict unless that particular client has a transaction in the office at that time. Again, I'm not an expert on conflicts, and I no longer have much of a real estate practice, so if anyone in the audience of the panel has a better answer. Any other questions? Okay, at this point we'll turn to what happens when things go sour. As I mentioned in my presentation this morning, one advantage of a written partnership agreement is that, if nothing else, it usually spells out an orderly manner of dissolving the partnership. But there are many, many law partnerships in this province that do not have written partnership agreements, and if the worst happens and the partnership is dissolved, the provisions of the Partnership Act apply. In these circumstances, quite often, in my experience and the experience of the panel, the file or the partnership dissolution will end up in the hands of a litigation lawyer. Our next speaker is just such a litigation lawyer who has acted in these circumstances and has experience. Our next speaker is Nancy Spies. Nancy is a partner in the firm of Stockwood Spies, was called to the bar in 1978. And Nancy, without further ado, sorry.
That's all right. Good morning, everybody. As Bob has said, my paper deals with the dissolution of a law partnership, and I'm dealing particularly in a situation where there is no partnership agreement. I had the opportunity to speak on dissolution of law partnerships generally, but when I came to write it, given that I'm writing it from the point of view of a litigation lawyer, I realized that most of my experience was in the situation where there was no partnership agreement. The reason, of course, for that is obvious. If you have a well-drafted agreement that in particular deals with what will happen when a partner withdraws or the firm dissolves, you simply apply the terms of the agreement. Now, there may be issues as to the interpretation of the various terms that arise, and if they do, there may be litigation, but in my experience, it's rare, and if issues do arise, they're generally fairly narrow issues with respect to a particular aspect of the rights of the departing partner, and they're more easily resolved by way of settlement negotiations. If, however, you are in a situation where you have no partnership agreement, you have a partner leaving, you're going to find, as I take you through this morning, that there are a number of issues that have to be dealt with. They're all particularly difficult issues, and so as a result, you've obviously got a greater chance for serious dispute and a much more greater likelihood of litigation. You'll see that in addition to my official title, I've entitled my paper, Physician Heal Thyself. And I may be influenced by the fact that I see mostly cases where there are no partnership agreements, but I agree with what Bob has said. I believe that we're notorious, like physicians, for not heeding the advice that we give to our clients, and too often people go into a legal partnership without any agreement at all, or if they do have some agreement, it deals with the obvious things like how to split profits, and doesn't deal at all with the question of dissolution. I'll be taking you through a number of topics, including the events which trigger dissolution, the Partnerships Act and the sections which govern dissolution, valuing the assets on dissolution, dividing the pie and the actual distribution, and then finishing off with some tactics and remedies. As we go through, I think you'll see what I mean about the problems that are so difficult. You'll be hearing from Bill after me about the tax consequences, which can be quite serious on dissolution. So my main message this morning, which you've already heard and I think you'll hear again, is you don't have a partnership agreement, by all means sit down and negotiate one. If you have one, take a look very carefully at the provisions with respect to dissolution, keeping in mind the various issues that I'll be taking you through, and make sure your agreement addresses the various problems that can arise. Dealing first of all with the events which can trigger dissolution, take a look at Section 32, subsection C of the Partnerships Act, which provides that subject to any agreement between the partners to the contrary, a partnership is dissolved by a partner giving notice to the other partners of his intention to dissolve the partnership. Now, there's obviously also sections which provide for automatic dissolution on the death of a partner or the insolvency of a partner, and there's also provision to go to court to ask for an order of dissolution. Now, in the absence of an agreement to the contrary, the mere withdrawal of a single partner from a firm of whatever size, it's tantamount to dissolution. The reason for that is that the courts, and I've cited some cases in my paper, and they're very old cases, but the courts seem to prefer what has become known as the aggregate theory. The partnership is a sum of its partners. So anytime there's a change in that structure and one partner leaves, the partnership as an entity dissolves and a new partnership forms with the remaining partners. And so it's an aggregate theory as opposed to some sort of entity theory such as a corporation. With respect to dissolution, there's no need for a formal notice under the Act. The notice doesn't have to be written. The cases take a look at the actions and words of the departing partner. The test in the cases, and again there I'm dealing with some very old case law that's set out in my paper, is whether the departing partner has manifested an intention to discontinue the partnership. And with that sort of language, you can see that any time a partner decides to leave the firm, you're going to have a result of dissolution. Now, when that occurs, the first thing you have to consider is the date of the dissolution. And that's important because it's the operative date in terms of deciding upon the value of the assets and distributing the assets. The Partnership Act talks to that, Section 32, subsection C again, makes reference to the notice of dissolution. It can specify a date of dissolution, partner giving intention to leave the firm a month away in time, or if there's no date specified, the Partnerships Act provides that the date of dissolution is the date that the notice of dissolution is communicated. If there's no formal notice as such, that the date of dissolution is going to be the day that the partner actually withdraws from the firm. I don't want to tread on any tax matters, but I would like to point out that the date of dissolution from a commercial point of view is not the same as the date of dissolution from a tax point of view. Though, correct me if I'm wrong, but from a tax point of view, generally, there's dissolution from a tax point of view when all of the assets are distributed. And that is generally going to happen sometime after dissolution from a commercial point of view. It's fairly rare that when the partner actually leaves that all of the issues are resolved and the assets distributed. Now, if there's no partnership agreement dealing with dissolution, you have to take a look at Section 44 of the Partnerships Act, which sets out the rules for distribution of partnership assets on dissolution. And I've set it out in my paper, but just to summarize, the assets of the firm are applied in a particular order under the Act. The first thing, of course, is that all liabilities to third parties must be taken care of. Secondly, you pay out any advances made by the partners which have not been treated as capital. The third thing that's paid out is each partner's capital. And then finally, if there's any residue, it's divided in accordance with the proportion in which profits are divisible. I'll come back to Section 44 and take you through an example a little later. Now, the next thing you have to consider is the valuation of partnership assets. The starting point is that you have the firm accountants prepare financial statements for the period starting with the start of your last fiscal year and ending with the date of dissolution. So you're no doubt going to have a shortened fiscal year, and financial statements are made in the usual course with the normal year-end adjustments. You then take those financial statements and you have to look very carefully at the assets and liabilities. And a number of adjustments are going to have to be made before you can consider the distribution of the assets. For example, with respect to hard assets, you may have to adjust upwards or downwards to bring them in line with fair market value. The firm's office equipment and furniture, most likely you're going to have to adjust it downward. It may be on the books for more than its actual value. On the other hand, if the firm has a nice art collection or the size of a library, you're going to be making upward adjustments to those items to reflect fair market value. You may or may not be able to agree on those items, otherwise you'll have to bring in professional evaluators. Take a look at your accounts receivable and what you've been using as a reserve historically for bad debts. Is it realistic for the year in question? If you've had a major client go bankrupt and leave you with some substantial accounts receivable, then you've got to take that into account and adjust your accounts receivable downward. There's going to be additions to the financial statements, and this is the most important area for you to consider. The most important addition is work in progress, or WIP. Generally speaking, law firms do not record WIP as an asset on the financial statements. Depending on the nature of your practice, however, WIP may be very substantial and obviously is something that you want to consider at the time of dissolution. It's usually valued as unbilled time, although some firms involved in insurance work, for example, might have a factor in, depending on the amount of issue in a file, and may or may not keep very good dockets with respect to time. So you have to take a look at how you value it in the first place, and you have to value it at 2 points of time. You have to take a look at the value of the WIP at the point in time immediately prior to the departing partner becoming a partner, and you have to look at it again at the time of dissolution. And you'll see the reason for that in a few minutes when I take you to a particular example. Once you've made those valuations for WIP, you also have to make the same sorts of adjustments that you did to the receivables. Take a look at whether there are going to be some write-offs, and also if it's your practice to charge a premium bill over time, and that's done routinely, there may be some sort of a gross-up that has to be applied to the WIP. The other item that does not appear on the financial statement is goodwill, and that's a difficult issue. The question is whether or not it should be considered at all when the partnership dissolves. There's one school of thought that goodwill cannot exist at all in a professional practice. Another school of thought is that there can be goodwill in certain circumstances, but it's a type of goodwill which is irrelevant on dissolution. In my paper, I quote from an article by Robert Milnes, The Fair Market Value of a Law Practice. And I think the easiest way to give you his argument is to read the quotation. He states that in the case of goodwill of a law practice, the goodwill stems from the expectation of future business that a purchaser would receive by paying for the right of access to the seller's client files. The lawyer develops a special relationship with his clients, and this personal goodwill adheres only to the lawyer who has developed the relationship. It cannot be passed on, and it has no value. The goodwill of the law practice, on the other hand, being the right of access to clientele, can be passed on and does have value. The seller is only giving, and the buyer is only receiving, the right to offer legal advice to an established clientele. So what Mr. Hitchman says is that there are two types of goodwill. One that he calls the right of access goodwill, which attaches to the client files and has some value, and the other which adheres to the lawyers, being personal goodwill, which is of no value because it's personal to the lawyer and goes where the lawyer goes. On this analysis, assuming it's correct, that on dissolution, goodwill is probably irrelevant because you're dealing with a departing partner who is leaving. The market is going to determine goodwill and the allocation of goodwill because that person will take certain clients with him or her, and the question of the right of access is probably not going to be relevant. Now I'll turn then to what I call dividing the pie. Once all of the adjustments have been made and the additions to the financial statements have been considered, you've got the various values for your assets. You have to go back to Section 44 of the Partnerships Act to determine how, in fact, you're going to distribute these assets. And as I said, they go first to debts, to outside debts, secondly to advances made by the partners which are not capital, thirdly to capital, and then the residue is split according to the profit share in the firm. It's important to note that you're not dividing the residue equally. It's not an assumption of equal partnership in the absence of an agreement, but in accordance with the division of profits. And the other thing that the Partnership Act fortunately ensures is that the departing partner, if you apply the section properly, will only get a share in the increase in the value of the assets of the firm for the period of time that he or she was in partnership. And I'll give you an extreme example to show why these two aspects of Section 44 are so important. Let's assume you've got lawyer A who's been in a long-running practice, assets of $100,000, and we've put back in WIP, so that's included, liabilities of $10,000. She takes in partner B, who brings in, has to make no capital contribution. They agree on a profit split of 60-40, 60% in favor of A, and B stays in partnership for 1 week. They make $1,000 that week in profit, and then serves a notice of dissolution, or says, I'm going to leave. And B says, not only that, I want my $400, my share of profit, and I'd like 50% of the assets of the firm, $45,000, equal partnership on assets, because that matter hadn't been addressed. Obviously, a situation like that would be unfair to the partner A. In Section 44 of the Partnerships Act, if properly applied, will avoid that sort of injustice. But it's critical that before you turn to that section that you put all of your assets, at least notionally, on the financial statements, including WIP, at the point immediately prior to partner B joining, and then following it through to the point of dissolution. If you do it that way, you'll ensure that partner A gets out capital first, and it's not just the capital that you all see on your financial statements in your capital account, but it's capital that includes the value or is all the value in the assets prior to B joining, primarily things like WIP that aren't on the financial statements. Then when you apply Section 44 to this particular example I've given you, it's clear that partner A gets $90,000 being the net assets of the firm, and the profits are split for that 1 week of $600 to $400, and assuming there hasn't been any increase in the assets of the firm over that 1 week period, there's no residue to be distributed any further, so that justice is done in those situations. I've put in my paper 3 balance sheets to make this point and to illustrate this point, and I just want to take you to one because to deal with this question of WIP. It's not too clear. Hope everyone can see that. It deals with the situation. I'm not an accountant, so I should tell you that these are they're oversimplified, but I just want to illustrate this point. Deals with the situation where partner B joins partner A in an existing firm and then subsequently leaves and the firm dissolves. And what you have to do is to take a look at your financial sheets, as I've said, and factor in WIP. You'll see here that that's what I've done. I've taken a look at the pre-B hard assets. They're valued at $1,000. Pre-B WIP, the point in time prior to B joining, was valued at $1,000, also shown as an asset. And then you'll see on the liability side the debt of $100 and A's capital of $1,900, which includes that WIP component. And then you have the post-B gain in assets and the post-B gain in WIP on the asset side. And I've shown on the right-hand side, the liability side, the $400 residue, and obviously your balance sheet has the total. Now, the effect of putting WIP on the balance sheet is that the total assets are $2,400. The pre-B debt is $100, so it leaves a total of $2,300 for distribution. A will get the capital out of $1,900. The residue, which I've shown is in effect the total gain in the firm from the time B joined, is $400. And that is split in accordance with the section in accordance to profit split. So whatever the profit split is, that's how you split your residue. But notice how important it is to put WIP on the balance sheet. If WIP were not on the balance sheet and you were to go and apply Section 44 to the existing firm financial statements, you'd end up with a situation where A's capital account would be, let's say, the $900 figure. WIP would be off the balance sheet. A would get $900 out of capital, then you'd go to residue. WIP would sort of be lumped in with the residue, and so WIP would be split as a residue situation on a profit split situation, and effectively A would lose a substantial portion of the WIP that A had kept and brought into the firm at the time B joined. So that's why you're doing this notionally, but it's important to put all the assets on the financial statements. Now, as I said, this balance sheet and the others that you'll see in my paper are to illustrate the point only. In fact, the post-B gain in assets would be reflected not only in the capital accounts, but also as true residue. And you'd need an accountant to actually do the adjustments and the calculations. But this gives you the general thrust of how Section 44 ought to work if it's done properly. Now, dealing then with distribution, in theory and on paper, what you're really doing is distributing all of the firm's assets. In practice, what happens is that a departing partner will take some assets in specie and then the valuations have to be done, and there's a chance that the departing partner will be owed some sort of cash payment. Then the issue arises as to the timing of that payment. And it's a difficult question because you've got competing interests. The departing partner has either set up a new firm or has gone into a new partnership and needs capital. The remaining partner or partners are faced with some financial problems in all likelihood. They've got the same amount of overhead, the same amount of space and staff, and they've got one less source of revenue. And so those interests obviously clash. Generally speaking, I think it's unfair, subject to the circumstances of dissolution, for the departing partner to insist on an immediate payment out of any money still owing. And from a practical point of view, it's not going to be possible for that partner to insist on an immediate payment. You'll see when I deal with the tactics and remedies, there is no way to force such a payment, and so the remaining partners really have the upper hand when it comes to actually the timing of the payout. One other asset that has to be considered, of course, is ongoing files and clients. And you have to deal with the question of the ongoing files, the files that are in the office, and of course, future work for those same clients. With respect to ongoing files, the main concern, of course, is the client's best interest. The remaining partner may, in fact, have the substantial connection with a particular client, but there are going to be files for that client that are possibly being worked on by the departing partner, and it's going to be up to the client to decide where the files will go. The client may want, in those circumstances, to have the departing partner take the file and complete it to avoid the obvious duplication, time, and expense. If that happens, you've got to take a look, of course, at the WIP on that file. There's possibility that the simplest way, if you can do it, depending on the client, is to bill out the file at that point. If not, the departing partner is going to have to account for the WIP taken on the file once the bill is ultimately sent. I suppose if you've got a situation where there are a lot of files in that category being taken by the departing partner, the remaining partner may want to take a look at this right of access goodwill that I made reference to, in the sense that that is a situation where the departing partner is taking some files, not because of any personal goodwill, but because of the circumstances, and in effect getting the right of access to those files. Now, when you're dealing with clients, generally, the partnership agreement, if you have one, can deal with competition and the division of client files. But if there is no partnership agreement, Section 30 of the Partnerships Act provides that partners can't compete with the firm. Case law, however, is that obligation ends on dissolution, so that subject to any non-competition agreements that you have, on dissolution, all of the partners can compete for all of the firm's clients. Just talk a moment about tactics and remedies. If you are in the unfortunate situation of being involved in the dissolution of a partnership without an agreement, you're going to need accounting advice, tax advice, and litigation advice. And it's expensive because of the number of professionals involved, but it's important to get this advice immediately. The reason is that if you don't, and particularly the tax advice, you may take a step in terms of how you deal with your books and records on dissolution that's going to prejudice you and have serious tax consequences. It's going to commit you to some course of action you don't want to be committed to. You could prejudice yourself as well if litigation is going to result. And the other thing, which is, I think, obvious, is that you're dealing in a fairly emotional situation. It's going to be hard to be objective during your negotiations with your partners. Now, obviously, you want to enter into negotiations, and you should make every effort in that situation to settle the dispute. Partnership litigation, like a lot of litigation, is expensive, it's stressful, takes up a lot of your time, and probably most importantly in these circumstances, it's public. We all like to look at the gossip section of the back of the Lawyer's Weekly magazine, so you want to keep these disputes out of the public eye if you can. Now, and even though, as I said, that the remaining partners hold the tactical and economic advantage, it's in everyone's interest, in my view, to attempt to settle the matter if it can be done on a reasonable basis. The problem that I've experienced is that partnership disputes, and I'm not speaking now only of legal ones, but certainly including law partnerships, are about, well, certainly just as acrimonious as matrimonial disputes. I'm a commercial litigation lawyer, and I don't think of myself as a family law lawyer, but in some cases, it amounts to the same thing. And so there is a good chance if you don't have an agreement, you're not going to be able to work out a settlement, and you're going to be into litigation. It's usually the departing partner that has to bring the remedy. It's very rare, I think, that the departing partner takes more than his or her share. And unfortunately for the departing partner, in my view, there is no speedy remedy. I think you could try to go to weekly court and ask one of the judges there to appoint a receiver or liquidator of the firm's assets, but I've certainly never seen it done successfully. I don't even know if I've seen it attempted, because a judge is going to be very reluctant if the remaining partners are carrying on a practice to appoint a liquidator and to in effect dissolve and liquidate the assets of practice. And even if a judge were to make such an order, you're into a costly situation in terms of the cost of liquidation itself, and it's going to take a long time for it to actually be done. So I think that the only practical remedy a departing partner has in those circumstances is to simply commence an action for an accounting and for payment. And even though the backlog in the courts are improving these days, it's still going to take you a couple of years to get that sort of thing resolved. For that reason, I conclude that if settlement is not possible, it's wise to consider some form of alternative dispute resolution. It's quicker and it's cheaper, and above all, in these circumstances, you can make it private. For your interest in that regard, I've annexed as an appendix to my paper an article by my partner, David Stockwood, entitled The Private Court, an Alternative. It's something that my partner's been working on for some time. He's setting up a private court, which we hope to have in operation soon. And a facility like that might be appropriate in dealing with a dispute of this sort. You'll have, you will take a look at the article, you have an opportunity to pick someone who is appropriate in the area, and you can deal with it in a private and expeditious way. In summary, I hope I've given you some guidance on what to do if you're ever in the unfortunate situation of dissolution of your own law practice. What would be better is if you use my paper and the other papers this morning and take it as a guide on the issues to consider in drafting a partnership agreement, and in particular the issues you have to consider on the withdrawal and the dissolution of a partner. It's easier to agree on these issues, obviously, at a time of peace. It doesn't have to be when you're forming a partnership. It can be an ongoing partnership. Certainly a lot easier to deal with them than from the time the partner leaves and walks out that door. And at the risk of repeating myself, I do recommend highly that you enter into a partnership agreement. Otherwise, you'll keep fellow practitioners who specialize in civil litigation like myself very busy. Thank you very much. Oops. Yeah.
Thank you very much, Nancy. Now we turn to another aspect of law partnerships, which is of great concern and interest to all of us as partners, the tax attributes of a law partnership. We have with us today a very experienced and distinguished practitioner in the field from our fellow professionals, the chartered accountants. Bill Strain is a partner in Deloitte Haskins & Sells and is National Taxation Services Director for that firm. Bill has been in this field for over 20 years, and I reminded him this morning that in 1977, when the Law Society special lectures were on professional partnerships, Bill was a panelist and speaker on tax attributes at that time. Bill is currently chairman of the CICA Committee on Taxation, and also co-chairman of the CICA Canadian Bar Association Committee on Tax Services. On taxation. Last month, Bill was made a fellow of the Institute of Chartered Accountants, which is a great honor in his profession, somewhat analogous to our Law Society medal. Bill, hand it over to you.
Thank you very much, Bob, and good morning, everyone. I was reflecting, as Bob mentioned, on the previous time that I spoke in this very same room, I think, Bob, in 1977, on at the special lecture series, and reflecting on some of the differences. It was back then, Milton, that the only way you could tell the difference between a lawyer and an accountant was the lawyer didn't have any slides. Two other differences, the topics that are covered here this morning, Milton's paper this morning and Linda's paper, make me realize more than ever that really the only difference between our two businesses is the product line, and even then there are some overlaps, as we all know. I'm very relieved that Bob didn't introduce me as an expert, because unlike Milton's definition, I've heard another one. Definition of an expert is a has-been drip under pressure. So with that, I think you have in your materials paper that is an adaptation of a chapter that I contributed to the debut publication on limited partnerships. I've adapted that for the professional scene. It provides basically just an overview of the scheme of the taxation of partnerships, and in this case with particular emphasis on those aspects that are important in the professional context. I don't propose to lead you through that paper this morning. What I would like to do is to really deal with four major issues. The first, simply to provide a very brief summary of the critical features of the scheme for the taxation of partnerships and where the focus points should be in terms of your planning and your setting out in your partnership agreements those things that will have an impact with regard to the possible unfavorable application of taxes at some point. Second area I want to focus on is some of the details concerning the tax reform changes that have particular impact on professional practices in our business in general. Those, as you may know, have now been incorporated into draft legislation that was released on the 13th of April. In some part, we're still awaiting the release of many more details in future legislation to be tabled later on. The full expectation is, however, that the bill will be introduced to Parliament towards the end of May or the first week in June, and in the government's view, it's absolutely mandatory that it be passed before the end of June so that the reductions in the source deductions for employees emanating from the tax reform exercise can indeed take effect on July 1. If that doesn't happen, the government's in even more trouble. So we'll deal with that for a few minutes. The third area I want to cover is some particular emphasis on tax deferral. Every bit as important as ultimate and overall tax reduction is the savings that can be generated if you can indeed defer the tax liability for some period of time. I want to explore some of the aspects of that, and then as a subset of that, to explore with you some of the ramifications of properly tracking the WIP deduction for tax purposes. It's one of the areas that I think is ignored and one of the areas that creates tremendous difficulties as a firm evolves over time and new partners come in and partners retire or leave the firm for various reasons. All of a sudden, the last guy out the door who has to turn off the lights faces an enormous tax liability that he had no idea was laying there in wait. Dealing with the first subject matter then, a partnership from a tax perspective has a unique position. I refer to it in my paper as a quasi-independent entity. In many ways, it is treated for tax purposes as a separate entity like a corporation. In one very important feature, though, it is not, and we're all aware of that. That is, although income for tax purposes is determined at the partnership level, that income is taxed in the hands of the individual partners according to their particular profit-sharing arrangement. Now, as income flows out of a partnership, it really doesn't matter the form that it takes when it's paid to the partners. As Bob was mentioning earlier, there can be many different formulae that are developed for the sharing of profits. Some firms would refer to some base as a salary or a draw, interest on capital accounts, and usually then some form for dividing the residue. Well, it doesn't matter what the category might be in your individual formula, all elements of that factor are treated in the same fashion. They're simply allocations of income which is regarded for tax purposes as business income, regardless of whether you call it interest, salary, or a profit sharing. That's an important distinction because some of the special rules that apply to interest and perhaps to salary do not apply in respect of that distribution of income. The other aspect is that the partnership income may be only one component of the determination of your overall business income. As individual partners, you'll have deductions available to you on an individual basis. The most usual and the most significant is interest. If you are required to make capital contributions to your firms, then interest on money that you borrow to make those capital contributions will be deductible by you against the income that is generated from the legal practice. Other deductions, though, can be available as well in relation to expenditures, entertainment expenses, and various kinds of expenses that under the terms of your partnership arrangement might be left to you as an individual partner to look after yourself. They, to the extent that they are related to generating income from your practice, will be deductible to you against your share of the partnership income that comes out. So there are two levels of deduction there that, or income determination there that are important to keep in mind. The second aspect, though, of this quasi-independent entity is the one that causes some trouble. If you don't think of the partnership as a separate entity, then you might tend to ignore transactions between the partner and the partnership. Those kinds of transactions, the contribution of property to the partnership, the distribution of partnership assets to the partners, are taxable transactions. If you've got a computer sitting at home, for example, you take it and you're going to contribute to the partnership. Well, under the tax rules, you'll be considered to dispose of that computer at its fair market value, which may give rise to a gain in your own hands. The partnership will be considered for its purposes to have acquired that computer at its fair market value at that particular time. Those are traps. All of these things that we're talking about are much more traps for the unwary than they are threats to the ungodly. There are tax-deferred rollover provisions within the income tax legislation that will allow you to transfer those kinds of assets in consideration for an increased interest in the partnership on a tax-deferred basis. In other words, your cost becomes the partnership's cost, and you have no tax effect as a consequence of putting the property into the partnership. But the key, you talk in the real estate business about the importance in the real estate business is location, location, location. The importance in this whole area is planning, planning, planning. You've got to do the advanced planning. You've got to be aware of these situations in order to overcome them by making the appropriate elections on time, ensuring that the consideration that is taken back on transfers of property to a partnership, for example, is appropriate to qualify for the particular rollover provisions. And that gets back to what Nancy was just saying on the dissolution. An unintended and unexpected and unplanned for dissolution of a partnership can be absolutely disastrous from a tax perspective. Because at that particular point in time, all of the assets of the partnership will be considered to have been disposed of at their fair values with the attendant tax consequences, potentially, capital gains, the realization of the WIP, which would be included in income, recapture of capital cost allowances on depreciable properties, computers and the like, that sort of thing. In addition to that, though, you'll have a deemed disposition of the partnership interest. And a partnership interest from a tax perspective is treated almost the same way as a share of capital stock of a corporation. It is not reflective of an interest in the underlying assets and liabilities of the partnership. Indeed, it's treated as a separate property. If disposed of, if acquired, has the same kind of characteristics as would happen with shares. But because the income of a partnership is flowed through and taxed in the hands of the partners, the calculation of the basis of that interest in the partnership from a tax perspective is much, much different. And you see up on the screen here some, and included in your materials, an overhead showing some of the things that have to be taken into account in determining the cost basis of an interest in the partnership at any particular time. If you buy an interest in the partnership from somebody else, of course, the purchase price goes in. Any contributions of capital that you make as a partner to the partnership are added. And the income from a tax point of view, the taxable income that's allocated to you at the end of the year is added to your basis at that particular point in time, merely to avoid the double taxation impact. If that wasn't added to your base and you pay tax on it, and at the same time you dispose of your interest, well, you could face both a capital gains tax and tax as ordinary income, reflecting the same increase in value. A key element here is that the ordinary rule for tax purposes is that if ever your adjusted cost base, so-called, becomes negative, you've got an instantaneous realization of a capital gain and a tax liability. There is an exception made for partnership interests to that effect, that basis can go negative without any immediate tax consequences. And that's really in there, intended for professional partnerships because of the fact that income is only included in your cost base at the end of the year, but if you're drawing throughout the year against that income that's only going to fall in at the end of the year, you're naturally going to create a negative balance of your basis at a particular point in the year. So to have capital gains arise would be totally inappropriate at that particular point in time. That's all I'm going to say about the sort of the general scheme of things. I think you can look at the paper and read that at your leisure to delve into some of the other aspects. There's been a number of tax reform related changes that will impact professional firms, and I guess one of the biggest areas in the whole of the tax reform process, and I'm told the one that took up the vast amount of time at cabinet level in terms of discussing the proposals, were the automobile costs. As you know from reading the press and otherwise, deductions for luxury cars are now considered bad. A luxury car is going to be treated as any car that costs in excess of $20,000. You buy a car for $30,000 and you're deducting a portion of the car expenses for business purposes, then you ignore any amount you paid in excess of the $20,000 limit. What you see on the screen here is the comparable formula for restricting leasing costs. It's a three-part formula that says you take the lesser, the least of what you actually pay, which is a good point to start, $600 a month, which will be computed on a rolling forward type of basis, and then an allocation taking $20,000, which is the limit if you buy the car, over 85% of the manufacturer's suggested list price of the car in order to factor down the deductible portion of the leasing amount. The 85% just comes straight out of the air, and it's suggested that if you're a good bargainer, I suppose, you can go and buy cars for 85% of the list price. This rule applies to any car acquired after June 17, 1987, when the tax reform proposals were announced, but it does not apply for the 87 year, but only kicks in to apply for 1988. The additional bad news was that in the April 13th package, the government has clarified that they are going to extend the standby charge rules, to partners of partnerships. How many of you have got automobiles owned in the partnership? Better get them out. Effective for 1988, the usual employee standby charge rules will apply to impute a benefit of 2% per month of the actual cost of a car, or 2/3 of the amount of the lease charges that might be paid. Yes. Well, the management service, the question was, does that include a service company? And the answer is clearly yes. not only under this rule, but under the general employee standby rule, because if the management company owns the car, that car is being made available to the employee, namely the spouse or the individual practitioner. The general rule will be that it'll be much more cost-effective, tax-effective, to take the automobiles out of the management companies and out of the professional practices. That's not the end of the story on the cars, though. We've got what I referred to as a double whammy. Used to be, you used to fill out your tax return if you used your car, 50% for business purposes, then you simply added up the amount you paid for gas and oil, you took your depreciation, your capital cost allowance, your interest charges, your repairs and maintenance and so on. Then you said, okay, just half of that, because I use it 50% for business purposes, is deductible. You claim the deduction. The government seems to think that fixed costs should be treated somewhat differently, because if you use your car not very much for business purposes, then the preponderance of the fixed costs relate to your personal use and not to the business use. So they've developed this ingenious formula to give you a so-called double proration. The result of that, when you work through the numbers, is, as you see the table on the bottom of that slide, that if you were to use the car 50% for business purposes, all you're going to be entitled to is a deduction for 25% of the costs. That's providing that the car is driven less than 24,000 kilometers on business during the year. And unless you're a salesman, I would doubt that many of us will get up to 24,000 kilometers a year on business. That thing gets really scaled down, as you can see. If you use it 30% per business, you're only going to get a deduction for the fixed costs equal to 9%. Now, fixed costs for this purpose are capital cost allowances, leasing costs, interest costs on money borrowed to buy the car, insurance costs, and they threw in license fees. Not sure why they threw in license fees. The next area is also a sore point to many of us, is the business meals and entertainment costs. An 80% allowance, a flat out 20% disallowance of any costs that are incurred with respect to entertainment expenses, meal expenses, convention expenses to the extent that they include amounts for entertainment and meals, and so on. The types of things that are included in that category, as I mentioned, are all meals, gratuities, cover charges, room rentals, theater tickets, sports tickets, the amounts you just paid to buy your skybox at the Dome, that sort of thing. It was a matter of some debate after the tax reform proposals were originally announced as to whether or not, if you go to a convention and all you get is one fee for the convention, then is any of that attributable to the other things that go on, the meals that are provided and so on? The answer was coming back, well, we don't really know, but probably maybe. The draft legislation released the other day allocates an arbitrary $50 a day minimum if the amounts are not otherwise specified as specifically related to that element. So you can thank the Law Society for the advanced planning that went in to cut this thing back to half a day so you wouldn't have to suffer the disallowance for your noontime meal. I'm fascinated, by some of the drafting that goes on. This is not to be critical at all. These folks are under enormous pressure, but I read the provision in the draft legislation, and it says that the amounts that are subjected to this rule are amounts paid in respect of the, quotes, enjoyment of entertainment. Now, I wonder, does that mean if you go to a Blue Jay game and you're a rampant fan, that if they lose, you can maintain that, gee, I didn't enjoy that, and get a full deduction, which may lead to the tax planning opportunity that only go to social events and entertainments that you don't think you're gonna like very much. From the legal firm's perspective, the key question here will be to bill or not to bill. If you've got categories of expenses, which you all will have, that will be subject to this rule, if you bill those expenses to clients, and if you separately identify those items on your billings, they will, in effect, be deductible to you, because they will be treated like client disbursements recovered from your clients as part of the fee you charge. That raises a big question. If you're dealing with corporate, commercial, business-type clientele, I don't think the clients will be particularly pleased to notice that you've identified separately those kinds of charges, because they will face the 20% disallowance. And all you're doing is passing on what they might view as your liability, tax liability, to them. But if you are billing individuals who would unlikely be entitled to a tax deduction for your fees in any event, or if you're billing to tax-exempt entities or non-taxable entities, municipalities, pension funds, you name them, then they will not care one whit that you charge them with non-deductible expenses, because they wouldn't be entitled to them anyway. It's going to be interesting to see what sort of percentage these kinds of costs make up in our billings as we go down the road. You can see the charitable organization getting billed $100 for the legal services, the accounting services, and $8,000 for the entertainment expenses. Another area on tax reform is the home office. How many of you have got areas in your home, studies and so on, that you're treating as home offices and deducting portions of the expenses? Not too many creative tax planners here. In any event, you're going to have to suffer a disallowance. The tests for deductibility on home office expenses are much more stringent under tax reform. You've got to demonstrate that the area is exclusively for use in the business, that it is used regularly and continuously, and it is your principal place of business, i.e. you don't have an office elsewhere that you're conducting the same business from, and it is used for the meeting of clients or customers. If you can't meet those criteria, then the expenses will be disallowed. The question was, since most people's houses are in R1 and you're talking about zoning for residential purposes, I presume, that if you're holding your home out to be a place of business, maybe you're in violation of the zoning laws. And I suppose that technically could be a problem. I doubt very much whether anybody would talk to each other. But it's going to be a tough test to meet in any event. The other area is the change in the Goodwill write-off. We talked about, or Nancy talked about Goodwill and the fact of what happens to Goodwill on dissolution, but when you're either merging practices or you're admitting new partners who are bringing with them their practice, then it is not uncommon to pay for Goodwill. Formerly, if you paid for Goodwill, you were entitled to set up 50% of the cost as a deductible expenditure and write it off at 10% on a declining balance over the future years. Those rules have changed in line with the changing taxation of capital gains, so that effective now, if you pay for Goodwill, you'll get 75% of the cost as a deductible item, but amortized on the basis of 7% a year. And if you work out the present values of those two combinations, given the current tax rates, you're no better off than you were before, but you're no worse off either. The other element, of course, the flip side of the coin comes into play, that formerly if you sold Goodwill, 50% of the proceeds were taxable. That has gone up to 75% as well. The interesting thing is that the transition to the new system, let's say that you bought Goodwill in the past and you've got $20,000 on your book as an undeducted residual of cost. effective for your first taxation year beginning after the end of last year, in other words, the one that's going to start or has started, you'll be able to increase the undeducted portion by a factor of 50%. At $20,000 undepreciated balance, you will be able to gross up to $30,000 and depreciate that at 7%. So that's a little additional benefit in there. Fascinating thing in the draft legislation that was released is that there's some very complex words in there, such that if you sell Goodwill for more than you pay for it, maybe nothing because you've developed it yourself, then those proceeds could be regarded as the equivalent of a capital gain and eligible for the $100,000 capital gains exemption. That was not a proposal that was brought forward in the original tax reform paper, but has now been incorporated into the draft legislation. At the strong suggestion, by the way, of a joint professional committee made up of the Canadian Bar Association, the CICA, the Canadian Dental Association, the Canadian Medical Association lobbied fairly strongly for that, and with some success. As I mentioned earlier, timing is all important when you're dealing in tax matters. That's not only how much you can reduce your tax today, but whether or not, indeed, you can defer the payment to the future. I would suspect that many of you are well aware of the timing issue. How many here would have taxation year ends that end any later than January 31? How many have year ends that end in January, early January? The benefit of the changing year end, of course, is that partnership income only comes to tax at the end of the fiscal year of the partnership. So if I'm carrying on a practice in 1987, I generate income in 1987, but my year starts January the 3rd, 1987, and ends January the 2nd, 1988, then I don't pay any tax on that income until I file my tax return for 1988. Of course, I have to pay installments. But you get, in effect, by selecting the year end to end near the beginning of the year, a one-year deferral on the payment of tax. In other words, you've got an interest-free loan from the government for a year, which you have to remember, you've got to pay back sometime. Other differences, of course, are in the work in process area. If you're including work in process in the firm's income and determining your share of that income by allocating that among the partners, including the value of the unbilled time, for income tax purposes, you can deduct the work in process in determining your taxable income. It was interesting that in the tax reform discussions, there was a great fear among the CAs and the lawyers that both the WIP deduction and the off-calendar year-end provisions would go. I rather suspect that the government really wanted to have the goodwill of the lawyers and the accountants in the country in selling tax reform and decided not to do that. There was an effort many years ago to deny the WIP deduction and force the professions to include the value of work in process and income before it was billed or realized. And through the good offices of the Canadian Bar Association, with briefs that stacked up yay high, that provision was defeated. The intriguing thing is that under US tax reform, no work in process deduction and individual partnerships of individuals must have calendar year ends. So the battle may have been won, but maybe not the war. And we'll have to wait and see. Mentioned in the paper that there's a requirement in order to affect the timing of revenue recognition that you've got to bill your fees without undue delay, because fees come in or income is recognized at the earlier of when you bill the amounts, when you would have billed the amounts had there not been any undue delay, and when you actually receive the money at the earliest of those times. I recall when that provision was introduced back in '72 of asking a senior official in Ottawa what was meant by the term undue delay, and he said, well, that's pretty simple. It's a period of time that because of its duration is too lengthy. Situation that Revenue Canada hasn't changed much. Those are the same kinds of interpretations you get today. We talked about, in the paper, there is a discussion of management corporations. I suggest to you that perhaps a preferable structure is a management partnership for a number of reasons. From a purely tax perspective, it offers additional tax deferral opportunities. But perhaps more importantly, it oftentimes provides an easier way out, an easier way in when partners are admitted, partners retire, or the firm dissolves. As Nancy was talking about, you're going to hopefully have provisions for dissolution in your professional partnership agreements. If you operate a management partnership rather than a management corporation, those provisions can be absolutely paralleled in the management partnership context. The key here is that the partners in the management partnership are your own personal corporations. Those personal corporations may involve yourself or your family members as shareholders. We talk about management service corporations and the income splitting opportunities, and in reality, though, in practice, when you get 3 or 4 families involved in one management corporation, you build in rigidities in terms of what you can do in planning. If you have a partnership where the income split is determined, that income flows to the corporations, and then you have the flexibility as to how that might be distributed in salaries, dividends, and so on among your family members. You've got a much more flexible organization. And the tax deferral opportunities are quite amazing. For example, let's say your professional practice has a year-end January 31, 1988. The income of that firm was earned from January 87, so let's call it 87's income. The fees that are charged by the management partnership, because of course you can never determine the final fee until after the event, those fees, while they're accrued by the law partnership and deductible as an expense in determining the partners' incomes, A and B, will not become revenue of the management partnership until its year end in July 31, 1988. So they are now 88 income. They flow to the individual partner corporations as 88 income, but if you want to flow them through the individual partner, they flow to the corporations at the fiscal year end of the management partnership, July 31. And gee, look, we established the year ends of the management companies at July 15, so they fall in after the end of the 1988 tax year of the management corporations individually. That income then becomes income for the corporations ending in July 1989. You accrue a bonus at the end of 1989, which is deductible to the corporation, and which you now have to pay within 180 days. And that can take you into 1990. So you wind up with income that might have otherwise been taxed in 1987, only being taxed ultimately to the individuals in 1990. 3 years. Aggressive, perhaps. In view of the new general anti-avoidance rule, advisable, perhaps not. But there can always be good and valid business reasons. Which brings me to another point on deferral, and that is the absolute requirement to remember it is a deferral. To the extent that you've got a year ending in January, you've got a work in process deduction, and by the way, many of you will, in terms of client disbursements, probably not claim them as tax expenses. They are deductible, even though they will ultimately be recovered from the client. Make sure that your accounting system records them as expenses and not charges directly to the receivable accounts or the work in process, otherwise you'll miss the tax deduction. Deferral advantages there, but talk about golden handcuffs on the wrists of your partners. If a partner from a law firm decides to leave and go into a salaried position in industry, for example, he's going to be faced with his tax liability for the year on the salary, and then all of a sudden all of these deferrals start to crash in and create tax liabilities that fall in later. In the ordinary course of events, he will likely have ignored all that and say, hey, we got this tax liability. That becomes particularly onerous on retirement. I have had partners of our firm in a steady parade into my office saying, God, I didn't realize I'd have all this tax to pay. I've borrowed against my capital account, and now you're going to tell me that the money that comes back in repayment of my capital account is actually work in process, and I got to pay tax on it, and I got to pay the bank. I'm short 50 cents on the dollar here. What am I going to do? That is a reality. It's most important that you maintain a very, very careful record of that deferred tax liability, and you make sure that you've adequately provided for it and are continuing to adequately provide for it. Otherwise, you could be faced with a huge surprise when you come to retire or leave the firm. Bob, I think that probably takes me to the conclusion. I've got a number of a series of about six slides, I guess, in the back of the material that tracks through different methods of dealing with the work in process allocation. And as I mentioned earlier, that is very important also to set up a tracking mechanism within the firm as to who has benefited from the deduction of work in process on a year-by-year basis. Because when they leave the firm or retire, if an amount of income equal to those previous work in process deductions is not allocated to that partner, and that's something you have to provide for in your agreements, then the guys who are left are going to face that tax liability. It does not automatically attach to the partner who had the benefit of the deduction in the past. It has to be provided for. So your systems should make sure, and your agreement should make sure that that is adequately covered off. So you can make some sense out of these slides, let me just, in a couple of minutes, Bob, just give you what the assumptions are. If you look at the first one, which is this slide, make a couple of notes under those columns. Under column 1, year 1, I'm assuming that we've got two partners, A and B, sharing 50-50. Under column 2, in year 2, the firm's admitted a new partner, C, and the profit sharing allocation is now 40% A, 40% B, and 20% C. In year 3, the new partner has earned his spurs, and he's now up to being equal, so that they're now sharing 1/3, 1/3, 1/3. Now, based on those assumptions, you can track through the subsequent series of slides, which shows you different methods of allocating the work in process. One essentially based on allocating both the opening position and the closing positions, one based on allocating only the increases or decreases, and as you see in working through those mechanisms, there's quite a different impact on the individual partners in terms of their tax liability. Arguments can be made in favor of either one of those methods or any other method that you may choose, including an individual allocation of the work in process based on your particular clients and situation. But I can't overemphasize the importance of providing for it on departure. The last 3 slides indicate that if you go into year 4, if you look at the third to last slide, which is that one, year 4 assumptions here are that partner A has left and has been paid out as capital, and partner B and C remain sharing 50-50. And the assumption here is that even though partner A left and took his WIP with him, so that from the beginning to the end of the year, there's really no change in the other 2 partners' WIPs. But if you look at the next slide and the subsequent one, you'll see the type of thing that I'm driving at. On the next slide, it will show you that partners B and C wind up paying tax on partner A's WIP in the year subsequent to his departure. That's what you've got to avoid. Sorry, Bob, I've run over a little bit, and I'll turn it back to you.
Thank you very much, Bill. Before I make some very brief concluding remarks, do any of you have questions of Nancy or Bill on the last 2 presentations? Okay. I'm sorry. Yes, sir.
I don't know whether there's any particular benefit one over the other. It's a question of what you believe to be the most appropriate in the circumstances. If you've got a practice perhaps that's rather homogeneous, and the partner who is being admitted is going to participate in that homogeneous practice, if you will, it may be more appropriate that he buys in to the opening positions and receivables and WIP and so on. If you've got a lawyer coming in, for example, in a different area entirely, and it's quite separate and distinct, and you want to reward him particularly based on his contributions, based on billings and so on, it might be more appropriate to go the other way, where he doesn't bring in any capital, but he basically eats what he kills. And there may be arrangements to make advances to him in terms of monthly draws until income can be determined and all the rest of it. But the beauty of the partnership organization is you've got total flexibility pretty well to make your own deals. That there is very little in the way of restrictions or rigidity that the tax system, for example, imposes upon your ability to do those kinds of things. No tax advantage. The tax consequences are different. If a partner comes in and purchases work in process, for example, then and that work in process is allocated to him, he will be entitled to the deduction for the work in progress and determining his share of the taxable income of the firm. Sometimes it's important when you're admitting new partners to make sure that they come in through the partnership, because this gets down to what I mentioned before, the critical issue that when your adjusted cost base becomes negative, it's not an immediate capital gain. If you're buying into a partnership, for example, for a third interest, in effect, you're buying half an interest from partner A and half an interest from partner B. If you make a payment directly to those individuals to acquire some part of their interest, they are going to have to recognize capital gain and potentially pay tax on that capital gain at the time of that transaction. If instead, and let's say the number is $100,000, you contribute $100,000 to the partnership, and they just happen a few days later to each withdraw $50,000 from the partnership, no capital gain. Those amounts simply on withdrawal would reduce the cost basis of their interest, may take them into a negative position, but they can wait until they leave or retire before they have to pay tax on that negative position. Another deferral that again is important to track. You may want to purchase it from them in the capital gains exemption environment because it's potentially totally exempt to them to sell at a capital gain under today's circumstances. But if there's any taxable implications to them, then you may want to consider going the other way. Just again points up the fact that you got to plan in advance. Don't do anything until you've kind of checked out the potential tax ramifications and whether or not there's a better way of doing it.
Well, any other questions? I'm sorry, yes. And
Just to follow up on what you just said, what tax implications are there to the partner joining the partnership if he buys the interest from the existing partners or he just contributes to the actual partnership?
could you repeat the question, Bill?
Sure,
for
Bob.
the-
Sorry, I forgot to do that last time. The question is as a follow-up to that earlier question, what are the tax implications or differences if a partner on admission buys his interest from the former partners, or indeed whether he contributes the capital to the partnership? And the answer to that is there's absolutely no difference from his perspective. A capital contribution to the firm creates a basis in the interest for him of the amount paid. The purchase from other partners of an interest in the partnership creates the same basis, so that there's absolutely no distinction in those two situations.
Any further questions? I'll just end this morning's session with some, oh, I'm sorry. Yes.
One question about work in progress. Do you see any advantage in any partnership back tax program reporting on a fully accrual basis?
Question is there, can I see any advantage in a partnership reporting income for tax purposes on a full accrual basis, including work in process? It would be a rare situation where I think there would be any advantage in doing that. You might, if you were anticipating a significant increase in tax rates, for example, over a short period of time, a couple of years, then to report income in advance of when it might otherwise be reported might tax it at a lower rate and offset the timing disadvantage in doing that. That gets to be a pretty much of a blue sky exercise in trying to decide when those rate reductions might come into play and how long into the future you'll get to realize the benefit and so on. But there are circumstances where that might be appropriate. But generally speaking, no. As long as you track it properly and you don't get yourself into some of the problems I was referring to.
Maybe in the supplementary to that, are there any disadvantages not for accounting purposes, including work in progress, as well as accounting?
Question is, are there any disadvantages in not including work in process in income for accounting purposes? And you mentioned accounts receivable. No disadvantages per se. It's a question of what the particular financial statements would be used for. If indeed you're using those financial statements to present to your your bankers in order to float a loan to finance your receivables in your work in process, i.e. your salary costs and so on, it would certainly be advantageous to have the work in process reflected on the financial statements at its fair market value to support the loan application type of thing. Certainly, under any accounting methods these days, I would think that the inclusion of accounts receivable is, to have any kind of fair disclosure of the financial position of the company, you would normally include accounts receivable. But there's tremendous arguments on work in process as to whether it's worth anything. You could say, okay, I'm going to record the cost of the unbilled time, but when you come to value that quote-unquote inventory, what's the value of a half-completed job? And Nancy, you were referring to some of the difficulties in valuing work in process, and that gives rise to many different approaches to it. But if you do not include WIP on your financial statements, then there is no deduction you have to come up with in arriving at your taxable income. And what you're doing is then allocating income among your partners without recognizing the work in process. And if you're in a changing partnership environment where people are coming and maybe going, question whether or not that's a fair allocation of the income of the firm when you ignore WIP.
Any other questions? I'd like to conclude with just 2 or 3 very brief remarks. I'm not going to give the presentation that's on the syllabus, my paper's there. I think listening to the panelists today, it's obvious that we're all practicing in a world that's changing very much. There are 2 basic changes that the law profession and law partnerships are undergoing. Marketing, for one. It's interesting that in planning this program in 1988 as opposed to 1984, it was very quickly decided that you could not do a program on law partnerships without a segment on marketing. We're all doing it whether we like it or not, and we're all going to be doing more of it. And as I've stated in my paper, I think it can make us better lawyers and produce more satisfied clients. The other change that one panelist, Linda, referred to is the technological change, and I'm sure that your experience is no different than mine. In 1984, when I chaired this seminar, I had an excellent secretary and a memory typewriter. I think it had 8 pages of memory. Now I still have the excellent secretary, but I have a state-of-the-art word processor that does all kinds of wonderful things and even spells if I can't or my secretary can't. There's the fax machine, that instrument of torture, as I'm sure lawyers used to call telephones 80 years ago. No longer can you say to a client, well, I haven't drafted the agreement because of the terrible mails, etc. I haven't received your letter of instructions. Usually the client has faxed the letter of instructions to us and expects the legal product back by return mail, by return fax. I'm now starting to use the excuse that the transmission was blurred, that leads to a retransmission. All these technological developments, you all have them to a greater or lesser degree, or you'll have them soon enough. It impacts on the bottom line of our practices. Good old Mabel, a senior partner secretary who used to buy the typewriters and talk to the serviceman when they didn't work, it's no longer sufficient. Either law practices, large or small, are either going to have partners who are willing to learn something about this technology or hire outside professionals who do. These, to me, are the 2 profound changes we're going to see, but they all will result in one thing, that I think law partnerships will no longer or increasingly will be less mystical entities carrying on a mysterious profession, and hopefully will become efficient and business-like organizations. And I think that it will produce more respect on the part of our clients, who, as Milton said, if they understand what we're doing, they'll be willing to pay a reasonable rate of return. I'd like to thank all of the panelists for their presentation this morning, and I'd like to thank all of you for attending. I hope you found it useful. Thank you very much.